intrinsic value. First, let's apply the Grams formula revised. To do this, we plug in the earnings per share over the last 5 years and divide by the current yield on AAA corporations to get an intrinsic value of $7.91, which is quite different to the current trading price. But let's move to the discounted cash flow model. Here I plugged in the free cash flow over the last 10 years and calculated the average growth rate. I then looked at the analyst growth rate, and accordingly I calculated the average growth rate, which I used to project the future free cash flow over the next 10 years. I then used the discount rate to project the present value of all future free cash flows, which I summed up and added any cash and cash equivalents, subtracted any debt, and got an equity value of $141 billion. I divided this by the shares outstanding and got an intrinsic value of $19.78, which isn't that different to the current trading price. Let's move to the multiples valuation model. Now, the only companies I think are comparable to AT&T is Virgin Communications and Frontier Communications. I took their current stock prices and divided by their earnings per share to get their PE ratios. I then averaged out those PE ratios and got an average PE of $10.75, which I multiplied by AT&T's current earnings per share, which is negative, and got an intrinsic value of negative $11.94. Let's move to our final valuation, which is a dividend discount model. Here I plugged in the dividend yield over the last 5 years and calculated the average growth rate, which is at 1.3%. I then calculated next year's dividend, and using the WACC, I calculated the intrinsic value to be at $25.40. Now finally, let's evaluate our stock by averaging out the Grams formula, multiples valuation, discounted cash flow valuation, and the DDM valuation to get an intrinsic value of $17.70. Now normally I would apply a margin of safety of about 10 to 15%, but according to our 9 pillars, which